Hello, traders. It is Wednesday, May 1st. Mayday, Mayday, Mayday. The Fed is going to release their statement in a couple of hours, so this should be an exciting session for us. We'll see what they've got to say. Say hi to Harry, everyone. Harry,
hey, everybody.
welcome aboard. Yeah, so we've got really unique market set up right now. I feel that, if you listen to CNBC, every single FOMC statement is the most important one ever. I actually think this one is going to be pretty important. We'll get into that in just a bit. We're going to take a look at our previous picks. PANW was my pick from last week. I have been leaning bullish. We're looking to sell an out-of-the-money bullish put spread, keying off of the 270, 250, 270 bullish put spread, 50-cent credit. That was definitely there, and it should be trading for less than that now. So still way out of the money, neutral to slightly bullish strategy because we don't know what's going to happen today. And the other pick that I put out was APH on Sunday. And that was also a bullish pick. And you can see that the stock is pretty much where it was Monday morning, which is a testament to trading relative strength. So, Harry, what was your pick last week?
It was BABA. I picked BABA long. And as you can see here, BABA, when I picked it last Wednesday, it was around 73.75. It's now 75.83. At any point of the day after Thursday, Friday, any of these days here, you could have taken profit. You can take profit now. I still like BABA. I still think it has room to grow. Would like to see it get above 77 here. Would be a good buy zone for it to add to it. If you're still in the trade, you could add at 77. But I still like it. So that was my pick. That would have made a decent profit for anyone who took it.
Yeah, and I noticed that FXI was also breaking out, and that was another confirmation for your pick last week. We had this very long-term downward sloping trend line that we had pointed out right here that was breaking out to the upside. So you've got Chinese stocks moving that way. I did happen across a long today that was interesting. It's not going to be my pick, but I do like that heavy price volume and the price action on a day when the market has been drifting lower, has been super steady on the way up. That is NIO. D1 chart, you can see big breakout above AVWAP-E, above the 50-day moving average, heavy volume, got lots of room to run to get up to that 100-day moving average at about $6. So it's got a 10% move before it even gets to that resistance level. So I do like the price action today. I think it's going to keep going.
I like it. I also like that it has this, if you take from Wednesday, March 27th, the top of that, you can connect it. It has around 4 touch points there. It pretty much goes right into the 50 SMA. And today, so not only did it break the SMA, it also broke that upward ascending algo line. And so you have 2 breaks of resistance on this. You don't have earnings to June 14th. I like this one. This is, and you also have pretty heavy volume today already.
Yep, it's been very steady. So that one looks pretty good to me. I've got a couple of others that I like as well. I'm going to do some technical analysis on the market. I'm going to give you my sentiment, and then I'm going to let Harry take over from that point on, and he can talk a little bit about the Fed and what his expectations are today. You can see this is a 5-minute chart of the S&P 500. I'm going to shift to the daily chart. And so we had this pullback right in here, and we bounced above the 100-day moving average. Everything looked pretty good in here. We've been looking for the bounce. We've been playing the bounce. And first and foremost, gee, Pete, you got this wrong because the market bounce isn't all that strong. Well, we started adding in here, and we've been long financial stocks. So financial stocks have done very well. And these are starter positions. What I wanted to see this week was I wanted to see follow through, and I wanted us to attack a VWAP Q, and the 50-day moving average. A VWAP Q is the green line. The purple line is the 50-day moving average. That could still happen today if we get a dovish Fed statement, but we would have to blow, and I mean blow through this level. I don't want to be poking at it. So long green candle and through. Now that we've seen this price action, I was also looking for something more steady, stacked green candles in here, because that would have told me that buyers were aggressive and that there could be some short covering once we get through these resistance levels right here. But I'm not seeing it, and this is turning into a wimpy bounce with lots of retracement. And we did have the GDP came out last week that was fairly soft, down 2% quarter over quarter. It was a 1.6% increase. That is not really strong growth. And so
I took a NEO trade, by the way, Pete.
all right, nice. We'll check on that a little bit later too. So now that we've pulled back, we have this upward sloping trend line on SPY that could be breached very easily, and that would be a bearish flag formation with a breakdown below that 100-day moving average. Given the price action that I've seen this week from Meta, Google, Microsoft, NVIDIA, Tesla, every big mega cap tech stock has been relatively weak. They're not leading the charge higher, and we've had all those earnings a week ago when we did our presentation. We still didn't know how those earnings were going to play out. Now we know that there's not any excitement coming from the earnings releases. And so I am going to exit my starter long positions before the FOMC statement. Given the price action I've seen in here, this is not the strength I was looking for. And I believe that testing that 100-day moving average is going to be very easy, especially if the Fed doesn't get on the dovish side. That's what the market wants right now. So, Harry, what are your perspectives? I know that you did a really a cool SPY strangle. So why don't you tell us about that as well?
Yeah, I did a strangle. I felt the premiums were good for that, lower premiums than one would expect on the expected move. And so I basically bought the 503 puts and the 509 calls, and I did that for a total of about $5. So today I sold those puts for around $475, basically covering the cost of the strangle, which means I now have free calls going into this FOMC. So if there is a dovish tilt to the FOMC, the market jumps up. And as we've all seen also, you sometimes will get this jump up and then a knockdown. But if at any time we get this jump up on SPY from the FOMC, I have these free calls just sitting there. I did the same thing with Tesla the day before, where I took the 205 calls and I took the 187.5 puts, and then I sold the puts for the price of the strangle. And that really is, you know, there's different ways to handle strangles, right? You can sell the whole thing as a spread where you're getting back or you're getting profit over your original cost. But another way to do it is if one side of the strangle gets to the, you know, if that option gets to a price that's equal to what you spent on the strangle. So let's say you spent $5 on the strangle, $250 for the calls, $250 for the puts, and the puts get to $5. You sell those puts. Now you have those calls free and clear. And what that means is that even worst case scenario, the calls go to zero, your position drops, you break even, right? So now I have two positions, both in SPY and Tesla, where my worst case scenario is break even. Anything that those calls are worth on Friday becomes profit. So if I get a jump in the market and Tesla goes with it and SPY goes with it, whatever those calls become are profit. So that's how I handle those two strangles on the market. I did take your NEO just now. I took the $4 calls for 517 at $1.37. They're almost at parity, which basically means I'm not paying any premium there, right? It's 0.9 delta. And so you just, to figure out how much premium you're paying, just take your strike price, $4, add the cost of the option, $1.37, That's $5.37. What's the current cost of the stock? $5.34. So I'm paying 3 cents, 3 cents in premium, right? Which is way less than 1% of the cost. So I'm basically 1-to-1. So this becomes a surrogate stock position in the challenge account. With 15 call contracts, I basically now have 1,500 shares of NIA. That goes out to May 17th. That's why I took that position. That's why I took 2 weeks out. And there's plenty of volume in those positions. So as for the Fed today, it's interesting because there is actually a new wrinkle. Now, normally when you think the Fed, you're thinking, all right, how much of this is going to be, obviously they're not cutting rates today, right? But is there going to be indication from Powell that they're still looking at rate cuts? Will it be later on in the year? You know, everyone's going to be parsing whether or not he has a dovish tone. But there is one thing that turned up in the last minutes that the people and investors are going to be looking for this time. And that is whether or not they're going to sort of reduce their QT program, the quantitative tightening program. And so currently, you know, the Fed lets around $50 to $60 billion in Treasury mature each month. What that basically does is it takes away $900 billion of liquidity out of the market every year, right? Every year, around $800 to $900 billion is being taken out of the market by letting those treasuries mature. There is some indication that the Fed is going to reduce that by half, that they are going to ease up on their quantitative tightening. It's not going to be quantitative easing exactly, but ease up on their tightening. And if they do that and lower it to letting around 30 billion mature, let's say instead of 60 billion, that puts an estimated $400 to $500 billion of liquidity back into the market at the end of each annually. That's a big deal. So while normally the focus is on rate cuts, this time the focus is going to be on an actual decision. Did they, not on his tone, not on his dovishness or hawkishness, but whether or not did they decide, hey, we're going to cut from 60 billion to 30 billion, the number of treasuries we're letting mature each month. And if they do that, even if they have a somewhat hawkish tone, you could see the market and the bond market certainly respond to that influx of liquidity.
Yeah, they've been so steadfast and so hawkish for so long that I think they're going to err on the side of not giving the market what it wants, because they have constantly hedged every statement with, yeah, you know, inflation is still persistent and we don't see the core rate coming down the way that we'd like to. The economy is strong. So we're really not in any hurry to cut rates. We don't need to, and we've already made that mistake before. And just the price action that I'm seeing this last week is softer than what I would have expected. So I think that some of those long-term buyers in here, when you see this type of choppy price action, where before they were gobbling up every dip like mad, never even got going. Now all of a sudden, look at this choppy stuff. If the buyers were aggressive, you'd have seen green candle, green candle, green candle, right up to the 50-day, maybe spend a couple days sideways, another green candle through, really put some pressure on these short sellers. Well, the sellers are still there, and this could easily be a double top lower high and a bearish flag. We don't know. So when you don't know and you're not, there are going to be moments as a trader when you don't know. And that's when you go to the sidelines, you wait for new information. And when you get that new information and that price confirmation, the price confirmation today would be a breakdown and a test of the 100-day moving average or a breakout above a VWAP-Q. Either way, I'm good to go. I'm flexible. So that is when I will be trading.
You know, there's a weird, it's kind of funny, but it kind of made sense when I read about this. So, you know, Powell is a purist, right? He believes in the absolute autonomy of the Fed. And it's no secret that if, there's an administrative changeover. Powell probably is not going to keep the job he has. So put aside his own self-interest in wanting to stay in the position that he's in. But the proposals on the table, if there's an administrative changeover, is to remove a lot of autonomy from the Fed. One thing that could affect that is juicing the economy. Nobody can juice the economy like the Fed. The Fed could juice the economy like that. I just wonder if there's a slight little among the Fed president's psychological error, maybe it's just a little bit of a nudge there to, well, serve the greater good. Fed needs to remain autonomous, juice the economy a little bit here. Probably not, but it has to be in the back of their minds, I'm sure. It's just one of those little untangibles, one of those X factors, so to speak, that lends itself towards just maybe. But we'll see today. I mean, Powell is, I happen to think he's a very good Fed chair. It's a very difficult needle to thread. They made a mistake in the very beginning, obviously, by thinking inflation was transitory. It wasn't. But since then, I think they have, resisted calls to stop the rate hikes when everyone said there's enough. And now they're resisting calls for rate cuts when they don't really need to, as long as the economy is doing well. So we'll see what happens. It will be an interesting meeting, but to think that they're going to cut rates when until unemployment gets over, bounces up from all-time lows is kind of ridiculous.
Hey, blame who you will, but in the last 25 years, when your deficit, your national debt goes above $30 trillion and you basically print $30 trillion, this just in, every dollar is worth less.
No doubt.
Gee, amazing how that works.
There's no doubt that the national debts around the world are escalating, but certainly the U.S. national debt needs to be dealt with. But, to me, for the life of me, will never understand why the largest pool of money in the world, in almost the world, which is Social Security and entitlement benefits, is just sitting there. It's not collecting interest. It's not even just being invested in like a pension fund would into the S&P, where people don't even have the option. Would you like your retirement money invested? If they would have just invested that money into the S&P from the very beginning, there would be we wouldn't even probably be looking at a deficit right now. It would be no problems. It's just boggles my mind. And a lot of economists, if you read it, are also curious why that money just sits there. It's just a lot of money to sit there not making money. You're talking about close to $1 trillion just sitting there not making money.
Yeah, the list is long as far as things that the government does that will puzzle you. That's certainly one. The other one is when we had 0% interest rates, why the hell didn't they start issuing 30-year bonds again? Kick that can way down the road. I mean, as far as you can, which they're very good at.
Yes,
just keep kicking the can down the road. Well, why didn't you punt that thing 30 years down the road so that you don't have to keep rolling your debt over? I think our average duration is about 3.5 years, maybe 4 years on our debt. And this year, they're going to have to issue $7 trillion in debt. So go figure. Who knows? I just watch price and I try and leave all the analysis for someone else.
But you know what? I mean, look, it's been pointed out many times. There's been a lot of oddities in price action, particularly when you look at this earnings season. There are things that just you would never have seen before. You're seeing earnings that, even with guidance, that is objectively good. The Microsoft earnings was objectively good on every level, but yet the stock retreated back to prior to earnings lows. The responses to earnings is just not what you would think it would be. You're seeing these huge exaggerated moves, which means you have these stocks that are very overcrowded. You have stocks that have unusually high short interest. You're getting short squeezes. You're getting these news-based pops. And when that happens, what happens is, the more a stock becomes sensitive to news events or short squeezes or irrationality, the less the technicals have that impact, right? Because the technicals are a mutually agreed upon rational price point of support or resistance. And algorithms and traders and institutions look to those levels as this is where I'm going to buy, this is where I'm going to sell, this is where my stops are, this is where my sells are. But then when you have, these sort of irrational news and so on, you're seeing more and more technical levels getting blown through like they're nothing, like they weren't even there on the charts. And now what happens is eventually the price action does correct itself, right? So you'll see something blow through the 50 SMA off of news. Like, look at what happened with Tesla's news. It jumped up almost to 200 off of news of full self-driving in China. As that news started to wane, and it turned out it wasn't exactly what people, then it started dropping down. But, anyone who jumps in on these large moves to begin with, oh, it broke the SMA. To me, it just means when you're in an environment like this, let your standard for confirmation be higher. If you see a break of an SMA, if you see a break of a trend line, don't just take it at gospel that, okay, now it's time to buy, now it's time to sell. Wait for that confirmation. See the volume, see if there's another day, look at the daily chart. Make sure that those breaks of support and resistance are confirmed and not just a gut news-based reaction.
Speaking of confirmation and speaking of Fed Day, I wanted to mention to everyone, do not trade the initial reaction for a good 15 minutes, if then, because we got a press conference. Oftentimes you'll see an initial move, you'll see it reverse on that press conference, and these are big moves.
I agree. I don't remember, Pete, the last time I saw a Fed move that just consistently went in one direction. Like, oh, look, initial reaction is spice going up, and then that's the actual reaction. I mean, almost always is there a period where it regresses back, and then maybe it bounces back up again. And yeah, wait it out. Wait it out. You might think, oh, I can catch some quick money. You don't know how fast those moves can be reversed off a Fed reaction. Faster than you can click sell or buy, certainly. So, and if you try putting in a stop, those stops are going to be destroyed the moment you put them in, because it's going to be triggered every time. Wait, have patience, and also look at these sectors. Look at what sectors are popping. Is the finance sector popping? Is the tech sector popping? That will give you a good indication of what is really driving something. And that's where you can start looking at the relative strength, relative weakness on those pops and get yourself prepared for once it settles down, where do you want to start putting your money?
Yes, and oftentimes, so you get lots of fluctuation from the announcement till the close. Usually with an hour left to trading, you can kind of tell what the bias is going to be for that last hour. But overnight, you oftentimes have that move reversed because everyone really starts ripping apart the statement and they start dissecting every word and every comma and, oh, no, we think it really means this. And then the next day you'll see a contra move. And tomorrow after the close, we've got Apple. Friday morning, we've got the jobs report. So there's a lot of news to digest in the next few days here.
Agreed. So I guess let's start looking at some stocks here and see.
I'm going to highlight mine. I like 3M. And 3M has been a dog of a stock for a very long time. And you can see
earnings, right?
This is this is a very long-term downtrend in the stock. You can see this is a significant trend line breach to the upside. It is above all the major moving averages. It's above these trend lines. These are our automated trend lines. You can see the earnings before the open yesterday and this gap up through horizontal resistance. Stock held all of its gap when the market did what? That. The market sold off, and it sold off hard. And if this were just a head fake pop up, wham, 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 it would have filled that gap. Today, market weakness. Stock moving higher. There are buyers in 3M. I like 3M. Both Harry and I are going to have a caveat to this, okay? It's going to be dependent on the dang news, okay? If the S&P futures are down 150 freaking points after the FOMC statement, do not buy anything. You want to be shorting. So make sure that you have that market strength. And obviously, we'd like to be charging towards that 50-day moving average after the Fed statement and challenging the top of this long red candle, the open of it, and moving well into those resistance levels before we take a long position. Same thing will be true on the short side. If we start taking out that 100-day moving average with a long red candle, fine. Then we can start taking a look at some short positions. And I do have a short to take a look at. And we'll get what Harry's picks are. TGT, I like this for a short. We had some nice long red candles here. We had excellent volume on target during the course of the day. The D1 chart, you can see how it's rolling over steadily. It's through this low minus trend line. It's through the 50-day moving average. It's through AVWAP-E, and it's got plenty of room to get down to the 100-day moving average. So I think this stock has a nice, easy path down to that support level. And if it attacks it, it could take that level out. Fed stays tighter for longer with any signs of economic weakness, you're going to see retailers take a little bit of a hit, and we're already starting to see that weakness right now, relative weakness right there. So those are my two picks for the day. And we might have lost Harry, so we'll see if he's able to log in here. So I'm going to continue to take a look at a couple of other things while we're waiting for him to get back on. We'll take a look at the market. And you can see how it's dead to
hear me now
right now. All right.
Am I
We've
back?
got Harry. Yep, we've got Harry back. So
I thought I lost you. Turned out you lost me. All right, good. Okay, now I'm back. Great. I love MMM. I think it's a solid pick. And I like if now you'd have to get out before earnings on this one. I like TTD. It's a surge into earnings stock. It has earnings next week, but I like the way it's holding on that 50 SMA there. It broke through. It's holding today. It's breaking upward. I like TTD also as a stock that's going to perhaps surge into its earnings number. You have to get out of this position before earnings, though. But TTD is a long pick on my side here.
Yeah, it's above all the major moving averages. I don't know if you follow AVWAP-E, but it's above that. I find it to be extremely relevant. So it's got a clean path to continue to move higher, and consistent with relative strength and relative weakness. Look at this stock. It's putting in a bullish engulfing candle and taking out that previous red candle from yesterday when the market is down. So this stock is actually higher than it was yesterday on the open when the market is clearly much lower. There's the opening of the market. There's where the market is now. Look at that drop. This stock is actually above where it was yesterday on the open. I like it.
All right, let's see. Should we
nice.
Look for a bearish pick?
I already found a bearish pick. I just mentioned TGT as my bearish pick.
I got you, TGT. I'm hesitant to do anything. I mean, obviously the semis are, let me think of the TGT here. Yep. Target. I mean, a lot of the brick and mortars are hurting. I mean, you certainly saw Starbucks sales there. The only thing on TGT, taking out the anomaly of March 15th, you do have this downward ascending trend line from the bottom of 3.5, connects to 313, 314, 318, and then right to the low of today. So I'm going to put an alert on TGT at 157.30. And if it breaks the 157.30, that's a nice short for me. And notice how Pete and I, what we do is, obviously a lot of these picks are contingent, like we said, on the Fed. And also we're putting alerts, right? And alerts, which so many traders don't use, and it just, I don't understand it, because alerts are the simplest free thing you can do. It costs you nothing. You put an alert. Hey, tell me when the price crosses here, right? Or tell me when it crosses this line. Simple as that, right? You draw the line. When this line breaks, tell me when. And it costs you nothing. And what it does is you just set it and forget it. And maybe a day later, 2 days later, alert triggers. All right. Doesn't mean you jump right in, but you look at the conditions. Maybe it's an alert from a month ago. You forgot it, but you can still look and see, all right, is this still valid? Alerts cost you nothing. If you set up a system where you have 30, 40 active alerts sitting out there, you're going to get trades presented to you on a platter every hour. Here's a new alert. Here's a new alert. Here's a new alert. And you can pick and choose. I mean, your best scanner is your own alerts. And I don't understand why people don't use that more often. Brian, you asked about Workday. I already closed that for a profit this morning. So, but I mean, Pete, doesn't it drive you nuts that people aren't just constantly setting alerts?
There's no emotional attachment to it. It can do whatever it wants. You're not tying up your capital. I mean, the list is long of benefits to setting alerts. Plus, if you're flipping charts, there's so many times I'll go through a bullish search and I'll see a couple of key anchor points and I'll go, this stock looks good from the bullish standpoint, but man, if this support level is ever breached, that would make a nice trend line. I'm just going to draw it there. And then lo and behold, the stock breaks down below it. And you weren't even looking at the stock for a bearish trend line breach, but you happen to see a couple of points that really made sense. Take the 10 seconds to set the alert.
There's a psychology issue that I've noticed a lot of traders. I mean, we've always talked about it, but there's that counter trend trade, right? That people like to have. Oh, let's go long SMCI right now. It's down $127 or whatever. That's sort of a mentality people have, because every now and then you'll get that bounce back, make money, and that's what you remember. But what you have to realize about something like alerts, to come full circle, is let's say you have an alert on a stock that's a $100 stock right now. You have alert at 103 and the stock moves up to 103. But then you start thinking, well, I just missed the move, right? There was a $3 move, a 3% move up in the stock. I just missed it. That alert's there for a reason. What it really is imagine a starting line. And that stock was behind the starting line. That $3 move moved it up to the starting line. Now there's a green light for buyers. Right? What that tells buyers is now I can go in and start accumulating this stock. It's past this hurdle. What it doesn't mean is, oh, now the move is over usually. What it means is now that signals that the move is actually about to get started. So a lot of people see these big moves down and big moves up and think, well, I've already missed it, so I shouldn't short SMCR. I shouldn't go long, this stock because it's moved up. That type of thinking needs to be reversed in order for you to be a successful trader. You have to be able to look at stocks that are going up and think it is a good time to buy. And you have to be able to look at stocks that are going down and know that it's a good time to short. Is if you start thinking now's a good time to do the opposite of that trend, which is a long way of saying the trend is your friend, there's no way your trading will be consistently successful. You'll have occasional big wins, but you'll have more often huge losses.
And speaking of SMCI, there's a beautiful downward sloping trend line connecting the highs. It comes into play right around the 50-day moving average, which would also take out the high from the earnings announcement. And if it gets above that level, it could be 5 months from now. I don't care when it is. I'm going to get the alert and I'm going to take a look at it, and that price point will still be relevant. Now, there might be other price points in that meantime and other trend lines that are drawn, but this is good till cancel. It's out there for a very long time. These alerts are just fantastic. And so on a day like today, when you're sitting on your hands, you're watching The Price is Right or whatever, however you're biding your time, this is not when you should be relaxed. You should be out setting so many flippin' alerts on the long side and on the short side. And no matter what the Fed does, the market's going to move. And you're going to get alert, 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 alert. And these are all going to be key price points. And you're going to be needing to have some trades that you can enter instantly. You know, if you're a day trader, if you're a swing trader, you're kind of waiting to see how the dust settles overnight.
Someone asked me about my WATAM on AXP. Obviously, I need AXP to bump up here. And why did I choose an expiration date that's only 2 weeks away on the long put? Normally, you go farther out than that. You're correct. Normally, you do. I'm treating the Fed as sort of almost an earnings event for a financial stock. So that's why I shortened the time spread to the long put. If I get a bump up in AXP and I get my short put to expire worthless, I'll sell another short put for next week, get 2 weeks worth of put selling in while having a close by long put to protect me. So that's the idea. Seeing a bit of a bump here in Tesla jumping. Not sure why, but it is. Also looking at the market, playing with VWAP. I'm not going to put much credence either way because this is all going to change in a matter of an hour and a half when the Fed comes out and just sort of blows these technicals out of the water. But that is, you know, for the moment, if you're doing some short-term trades, that's what you should be looking at here is right now on VWAP. But I kind of feel SPY's going to hang right around VWAP until the Fed. There's no reason for it to go below 500, no reason for it to go up at the moment until we get an announcement. How do you tell the difference between overextended and the mindset issue? Overextended is you know, another way of saying RSI, right? Your best way of doing that is take a look at some stocks. Take a look at NVIDIA, right? Now take a look at NVIDIA on, let's say, the beginning of the year, January. And now you see this rise from 490, somewhere around there, all the way up to over 1,000, right? Or close to 1,000, 930 or something. At what point is NVIDIA overextended on the long side? Is it overextended after its 50% move in 2 weeks? Well, a lot of people would say yes, right? I mean, the stock went from 400 to 600 in 2 weeks. So you're, you know, mid-January, you're looking at a $600 price point. Is it overextended in beginning of February when the stock's at 700? You have pretty much a 75% increase in the stock. What about when you get to March and now you have a 100% increase from the beginning of the year in NVIDIA? Is it overextended then? It's at 800. Oh wait, it goes up to 1,000. So when you're saying, oh, this looks over or underextended, no. You look at the price action. What you're seeing there, if you just take that out of the equation and you look at the price action, what you're seeing is an orderly upward trend on good volume in a stock that then goes up, 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 consolidates, doesn't break downward, jumps up again, up, 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 consolidates, breaks up again, consolidates, another break up. You have a very orderly climb. If you just took your own preconceived idea of this is an overextended, too much buying or too much selling, and you just looked at the price action, you would be very bullish on it during that rise, and you'd either keep a position or you'd enter a position. If you start thinking it's got to return, you know, reverse sometime, well, that's where you get in trouble because you're not sitting there with the knowledge that institutions have and everyone else has, and yet they have that knowledge and they're buying. So somebody out there is, you know, you're sitting there with just your gut feeling, and they're sitting there with everything in front of them, and they're buying. That tells you something.
Yes, and so you want to buy into these patterns, these nice, tight, orderly patterns. And when you talk about overextended does not mean short. Okay. But if you're looking to enter and it's moved away from the EMA 8, this is a really good gauge. Let the EMA 8 catch up to the stock, or let the stock pull back just a little bit to get that EMA 8 to where they're very close. Now you have another entry point. And so you buy in here, and most people would be looking to exit this position. You should be adding to the position, not exiting. When you get tight price action like this, and I'm not talking whippy price action all over the place, I'm talking nice and orderly with no dips. This tells you institutions are accumulating the heck out of that stock. Any chance that you get to buy it by the EMA 8 is an opportunity. Obviously, you've got earnings here, but you preserve that mentality. Now the stock starts getting a little parabolic. When I see a long red bearish engulfing candle off of a relative high, danger. Take your freaking gains and be done with it. This is a huge move. Now you can wipe the slate clean and see what it does after this point. But those long red candles like that, especially bearish engulf off an all-time high, that is your warning sign. That is legitimate selling. And you can see how NVIDIA has not been able to recover since that long red candle. AMD was a question. AMD was a question I had.
By the way, on Nike short, for a Nike short there.
I like that. I was looking at Nike. AMD, I shorted it. Did I do the right thing? Yeah, you can see how the stock has continued to move lower today. It's got this trend line breach right here. It's still got some room to the 200-day moving average. So AMD looks nice, and you can see the follow through selling here.
1 second.
And Nike, I'm going to bring that up real quick since you mentioned it. I was looking at that. I like that short. And you can see.
I did put something at 88.50 as alert because of that bottom there that you see, that consolidation from 4.3. I'm sorry, from 4.4 over to 4.10.
Yeah. Relatively weak. I like this breakdown below AV Web E. It's below all the major moving averages. So yeah, that all looks like a solid short to me. And today it's been drifting lower as well. I'm going to pop up something very quick. I'm going to give you a peek at something I've been working on. It's pretty cool. This is a 15-minute chart of SPY, and I'm trying to simplify the way that we look at OneOP. I've also made a couple of changes that are not going to change the oscillator, but you can see, I mean, there's your buy signal. It tells you to get out here, but then it's right back in on a buy here. You're short, but you're back in. So there's a little back and forth in here, but not too bad. I mean, that's a fantastic short in there. You've got a nice long there. You've got a nice long there. There's the short yesterday. And go into a 5-minute chart, you can see what it's been doing today. So today, and when you get into these flat markets like this, that's when you're going to get these back and forth signals. But these are pretty decent scalps even. So I think I'm going to just preserve them, and I'm pretty happy with the changes that have been made. You got a long there, you got a short there, you cover for a small loss. Yesterday you had a nice short in there. You had a fantastic short early in the day. So yes, as long as the market is moving and it's not trapped in a horizontal range, then you want to lean on it. So I'm hoping to get this out maybe in the next couple of weeks. I still have some work to do on it. And it'll be primarily for the S&P. So that's what tells us what side of the market to be on.
What do you think of Best Buy, by the way, as a short?
I like it.
Take a look at this. I mean, you have a nice breach of a perfect upward ascending trend line here that starts down on November 10th, comes all the way up to today, breaks down below it. You have some decent volume, a couple of previous days. I like this BBY short.
Yep, I like it too. I noticed it yesterday breaking below the 200-day moving average, and then today it had steady decline right on the open here. CLF was another one that was breaking down. That's another nice short.
I'm going to take BBY. I'm buying the 75 puts for $3.40 that expire on May 10th next week. I'm going to get them here. I'm going to try to get them here for $3.40. Let's see if it goes through. Let's see if I can grab these puts. I'm not going to at 340. I really like that break of that trend line there.
I've got a question I'm going to answer while you're doing that. Do we ever trade ETFs like XLE, XLF? Well, in the spirit of riding the fastest horse, that's why we don't trade the S&P 500. We trade individual stocks. An ETF has components to it, and I want to find the weakest component, and that is still going to be the fastest horse. So no, if I'm trading XLE, I'm going to find the weakest component that is selling off the most, and that is what I'm going to trade.
Someone asked me what I was thinking about my NVIDIA long on Monday. It was a pure momentum trade. I had a very short leash on it. I got out break even. I wasn't going to hold it overnight. Just grabbed 10,000 shares and got out the same price I got in. That's all it was. Nothing more into it. But a good question from Great One Goofy, who always has good questions. What do you think about this, Pete? A WATAM post FOMC on RTX, long the June 21st $100 puts and short the 102 put next week. I really like this trade. RTX is, you don't get more of a WATAM pattern than the way RTX is looking right now.
Well, and I've got historical implied volatility up on my chart as well. I hope all of you are using this tool. I mean, it's really helpful. When I'm looking at option trades, I could see instantly, look at the historical implied volatility has dropped. Right now, it's at 18. Okay, if you're looking for cheap options and even a cheap straddle or a cheap strangle, this one's it. I mean, you can go out in time, and this stock is eventually going to break out of a compression, and it's going to go one way or the other. And in fact, when you get these big market declines, like we saw in 2022, eventually the baby gets thrown out with the bathwater. That's when you want to start going in and looking for stocks that have very low option implied volatilities, and they may be stable, but eventually they're going to crack down. You can find some pretty good values in those options as well.
Yeah. Let's see. I actually had VIK, the IPO. I signed 10,000 shares of that and just sold it 24. Oh, not bad. All right. Sorry. Neo's still looking good. BBY dropping. Both the trades that I put on so far during this stream is working well. So I think TTD or Neo are my longs. I don't want to steal your long there, Pete, but I love Neo. It was a great pick by you.
I'm going to give that one to you, yeah, and I've got you for BBY for the short.
Mm-hmm.
Just an interesting observation, as you can see how VXX, which it's not VIX, I can't bring up VIX, I don't have that data, but you can see how VXX has been declining the last 2 weeks or so, which is a little surprising given how important I think the Fed is, the Fed statement is today. And, to Harry's play earlier, I think these straddles are going to pay off, and the strangles perhaps as well. It's going to be a big announcement today. I mean, I'm seeing us go to the 50-day or the 100-day in the next few days.
Mm-hmm. Someone asked about a CRM short. I mean, it's not terrible. There are better shorts out there. CRM is not relatively weak today. So you have a stock that's above VWAP at the moment. It's not relatively strong, but it's not relatively weak. I mean, if I look at the daily chart, if I had to bet gun to head, I'd say it probably breaks down to test its support. But I think there are better shorts out there than CRM.
Yep, a couple support levels here that it's got to get through right here. We've got these two trend lines, and you can see how the stock has been in a downward sloping trading channel, but very choppy within that channel. So the stock just can't, what we like to see is red, 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 red candle, just consistently leaking oil. And I think if you look at some of our picks, that's the kind of price action you're going to see. And then those breakdowns through the support levels.
I'm loving this BBY breakdown. It just keeps dropping.
Oh, yeah. Yeah, that's very nice.
It looks like an almost see a declaration of bankruptcy there. That would be perfect for the stock to drop, not perfect for anybody who works for BBY, obviously.
Well, and they sell bigger ticket items too. So if you're talking about higher interest rates for longer, and you are charging things on your 20% credit card, are you going to be going out to buy the new computer or the other stuff that they sell, the big screen TV? Perhaps not.
A lot of these brick and mortars, they run on a nostalgia, right? And I saw something that looked at the average age of the buyer. And if you look at whether it's Barnes & Noble or Best Buy or any of these places, the average age of the consumer in the store is much higher than the average age of the overall consumer. And a lot of that is nostalgia based, right? Where people who just like to go to the brick and mortar store. This is particularly prevalent in like a Barnes & Noble, right? There are people, myself included, who loves to go to a bookstore, buy the actual books. When in reality, you just have to go on your Kindle or whatever and you book 2 seconds flat, it's there. But there are people who like going there, and that's a nostalgia-based thing. The problem with nostalgia-based thing is that consumer base begins to die off, and the younger base that doesn't have that nostalgia come in. And so these brick and mortars begin to have a little bit of a declining user-based problem because they're relying on that nostalgia, but there's a whole younger group that have never experienced it. So it's interesting to see what's happening to a lot of these places. And obviously the Amazons of the world become the bigger beneficiaries. And you see Amazon's one of the few companies where it literally has never reported a decline in revenue year after year after year. This is a company that just keeps making more money. Wow, AMD got hit. Jeez, look at that. Down 15, SMCI down. I mean, look at these. Today,
NVIDIA's down. Yep.
Yeah. These chip stocks are getting wailed on. You had some pretty high expectations going in. But at this point, I mean, Apple might be an anomaly. It might be separate from all that. But there has been some bloodletting here. And I'm surprised the market is holding up as well as it is right now with this, downtrend in the chip market. I think it's because you have finances and healthcare and communications all up today. But usually when you see energy down and tech down on the same day, that's usually pretty bearish. So the only thing holding this market now is you have very low volume, as we talked about, and you're waiting for the FOMC, which could reverse everything, in an instant. So all we can do is wait on good old Blue Eye Powell.
Yeah, and there would be a lot of short covering if this thing does turn around, because I I've been hearing from an awful lot of people that, oh, this is it. We're going lower. I'm just going to wait for price to confirm for me. And when it does, then I'll join that bandwagon. So I'm not going to be early. I'll tell you that anybody that is early and that gets a big rally in here, man, there's going to be some massive short covering.
There will be. I agree. If there's an upside surprise here, if they cut those the quantitative tightening, if he makes some remark about they're no longer considering any rate hikes, even that alone might do it. Anything that this market can grab onto that would be seen as dovish, and you start seeing it jump up, particularly in tech and particularly in a lot of these chip stocks. And by the way, we are not saying go long any of these. We're not even saying take a flyer on out of the money calls or anything. That would just be like a scratch off ticket. However, we're kind of saying be prepared for it. Don't be surprised if you are short these things. You might want to be out of it before the FOMC, before the Fed announcement. It's not the minutes, because you could be trapped really fast in some of these shorts if you are exposed at this announcement.
Yep. Once the announcement happens, then you can do anything you want. You have all the information that you need. You'll be able to get confirmation for the price action. So be prudent. Wait for the number, then trade after it. Same thing that we do with earnings announcements. So if you would have wanted to gamble on AMD coming out one way or the other, you would have had an implied volatility crush. And if you would have gone in and you would have traded it near the open, you would have seen it continue to leak oil, weak relative to the market. You would have had plenty of opportunity to come in now that the information's already out there. D1 basis, you're seeing this trend line breach right in here. There's so much money you can make after the announcement that you don't need to take the risk before the number.
One thing that's there's no secret that probably about 90% of our audience here is losing money as traders. We hear it all the time. And it's kind of crazy because if you look back at all of our broadcasts here and you add it up, I think we've only gotten one pick wrong, right? So you probably had 2 picks a week. Let's say you've had 20, 30 trades that we've given you over the months, 30 individual trades. Here you go. This is good long. My pick long for the week, Pete pick long for the week. And out of those, 29 of them would have been profitable. But yet 90% of you aren't making money. And that is up here. That's a mental issue. It just is. That's you maybe taking that trade and it does well, but you're also jumping into something else. Or the trade worked, but it didn't work right away and you got freaked out because it dropped. And so you got out and then it went up and then up. So if you're listening to this and you've gotten 29 out of 30 good trades on these broadcasts and you're not making money, all you had to do was literally that's all you're trading. Just trade those 30 trades. That's it. And you'd be up. You'd be up a lot right now, but you're not. And that tells me, you really have to stop as a trader and think, what is wrong with me? Why am I not making money? It's not because the market is biased against me. It's not because there's something in the psychology of what you're doing that's screwing you up, that's stopping you from making money when you're literally presented with here's trade after trade after trade that works and you still can't be profitable. That is a mindset issue and you need to identify it. And if you can say that you have it, you actually need to maybe stop, go to paper trading, whatever it is you have to do, stop the bleeding, identify the problem, and then work to fixing that, because there's no reason why you all shouldn't be profitable right now. There's no reason. We're handing you these trades. It's like silver platter. Here you go. Go Neo long. Go this short. BBY short. Go here. Last week, go Bobble long. It's right there. So if you're not profitable and you can't also learn to find what we're finding on your own, there's a problem there that technicals can't fix. There's a problem there that's here.
I just set an alert on letter Z, Zillow. There's a low plus trend line that is in play. Earnings were after the close today, I
Yes,
believe,
earnings are
or they
after
were.
close.
Yep. So I just got an alert set because if you get a hawkish Fed today, okay, people aren't going to be buying as many homes. If the stock has a negative reaction to earnings, and I break through this support line right here, it's got a long way that it can fall before it gets to this next trend line, this next horizontal support level. I want to be alerted.
Yep.
I could drop one up here too. And I might as well do that. I'll just connect these 2 points right here, and I've got the stock bracketed for whichever way it decides to go after that earnings announcement. If it's above $45, cool. If it's below $40, cool. I don't care which way it goes as long as it does so with gusto.
Yeah, it's kind of amazing. The price of my house keeps going up, 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 but there's nobody out there who would buy. It's like, okay, so the house is worth more now than it was a month ago or even last week, but yet there's nobody who's willing to buy it. Okay, well, might as well just keep raising the price. I mean, sure. Okay, there's just no. I mean, that also shows a supply problem, right? I mean, when there's no demand, but prices are still going up, that means there's also no supply. And a lot of people are saying the housing, it's got to break one way or the other because it is at an impasse that, coupled with those high mortgage rates, that really is hard to break.
Yeah, the next generation of homeowners can't afford them, so they're having to go to the bank of mommy and daddy.
Yep. And then they rent and rent and rent and rent. And, I mean, it's, a lot of this, I mean, one thing interest rates will affect directly is the mortgage rate. So, that market's going to be also paying attention to. Everybody wants to see, not everybody, but everyone is looking to see whether or not there's going to be any rate cut, even if by December. It's funny how we started this year thinking there'll be 4 rate cuts this year. 4. The first one will probably be in May or even March. And now it's like, maybe we'll get one, maybe one rate cut we're hoping on. We just hope there's no rate increases. And yet the market still survived. So it's going to be interesting. This is going to be an interesting Fed. There's not going to be any, obviously, rate cuts this month, but it'll be interesting to see what he says. I'll be tuned into that speech pretty closely.
I've got a mega cap tech that I really like. We've highlighted it recently. I like Google. I like Google all in here. I mean, this stock was holding its own better than any other mega cap tech company. It was one of the only ones that posted earnings and flew higher. Okay, now it's giving those gains back. I get it. But the market has been super weak. If we get a decent market pullback, I'd love to see it sit right at this breakout here, which is right around call it 160 level, and just pull back to it and be as stubborn as can be, not retrace at all with a market that's falling. When the market finds support, I would be a damn willing buyer of that stock at that 160 price point if I get what I've just outlined. It's just, it's pulling back. It's filling in this gap. That's fine. It's still strong relative to the entire mega cap tech sector.
Yeah. I mean, I like Google. I like Amazon. I mean, those two stocks to me are the kind of, they kind of stand out. Maybe Apple will be one, but right now, Google, Amazon are bucking the trend. And I mean, it's also a thing of, that money goes somewhere, right? You have all this money, let's say in AMD, or it's in SMCI, or it's in Meta, or wherever it was, and bad earnings or earnings they don't like come out and they sell. But where are they going to put it, right? They could just sit there, or they could look at something like Google, look at something like Amazon, and say, okay, this is a safe place to park my money. Their earnings were good. The trend is good. Everything looks good about this stock. So a lot of the money is being diverted away from the NVIDIAs right now and into the Googles and the Amazon. So it's getting that's sort of beneficiary of the other drops.
I have a comment here that from Nodec that mortgage rates are not historically high. They are only high relative to where they've been in the last 10 years. Very true. 5% interest rates, 5.5% interest rates are really the historic norm on a 10-year. So we're right where we should be normally. It's just that we're so used to 0% interest rates for so long that those interest rates seem pretty high right now. You couple that with a very low savings rate, and yeah, it definitely reduces consumer spending.
The problem, no doubt, also is the people who currently own houses. I own a house right now. Like their mortgage rates are mortgage rates they locked in. You know, there has been so much home buying in the last 10 years that your average homeowner now, their mortgage rate is below 5%. So if you're a homeowner and your mortgage rate is below 5% and the current mortgage rate out there is over 7%, are you going to sell your house? Because let's say I sell this house and I go to buy another house. I'm effectively increasing my mortgage rate by doing that. Why would I do that? Why would I sell now and then go out and buy a house that is going to cost me another 3-4% mortgage on interest rate? So you have, the problem isn't whether it's historically high or low. The problem is that most people who own a house now have a good mortgage rate locked in because they got it sometime before 2022, 2021. And now, why would they go out into a market where they'd have to pay substantially more to get what they already have? They wouldn't do that. So that's why you're having where no one's selling, because why sell if you're sitting there with a 3.5% built-in mortgage?
All right. Well, you know, I think we might conclude a little bit early. You and I have got a busy afternoon coming up, and I don't see a lot of questions coming in here. So I think everybody else might be in the same mode today where they're trying to get ready for this Fed announcement. Hopefully they're out there setting alerts.
Someone just said real quick, they're worried about BBY because it's too far from the EMA. It's not think of it this way. It's not the distance from the EMA. It's the slope of the EMA. That is where you need to be looking, where if the slope of the EMA is matching the slope of the price drop, you're fine. If there's a divergence there, that's where you're going to start seeing that retracement back to the EMA mean. But right now, the slope of the EMA and the drop in the price of the stock are pretty much in line with each other. So don't look at it in terms of absolute terms of dollar amount or distance, percentage different distance to the EMA. Look at it in terms of the slope of the EMA and the slope of the price action. And that will start telling you if you're going to be looking at any type of potential reversion there.
And I'm going to show you a trick that you can use on BBY or any other stock where you feel like, hey, maybe I'm chasing this stock a little bit and I would love to try and short it on a bounce. So what would you like to see? Well, you'd like to see LRSI go positive and then roll over to where it's giving you a sell signal. So let's take a look at it on a 30-minute basis, and you can see, all right, there would have been a buy signal in here, and then it crosses back down here below 80. So there would be your sell signal. And you can see that currently Best Buy is on a sell signal, LRSI below 20. So you right click, you create an alert, you use LRSI or any of these other variables, HA reversals, excellent. So M30, LRSI, I would like to see it less than 80. Well, wait a minute, Pete, it's less than 80 right now. That's right. And our servers know that. So our servers know that it first has to go above 80 and then it has to go below 80. And when it does that, you're going to get an alert. I'm going to add this and I'm going to save it. And it would take me 3 seconds to place that alert. When I get a positive LRSI, it's going to mean that there's a little bounce in the stock. And when the stock rolls over and it's below 80, I'm going to get an alert. And if this move right here, more than half of it has been preserved, then that's going to be a really nice entry point for me. That easy. You don't want to chase? Cool. Set an alert. See what the next bounce does. If it's brief and shallow, that's a good entry point.
All right, everyone, enjoy the Fed. Like we said, and like Pete said earlier, don't jump on the first move. Don't jump on the second move. Don't even jump on the third and the fourth. Wait it out. Wait for it. So there's a clear direction. You have stacking green or stacking red with good volume, one after another. It's clear. The reaction to this is bearish or bullish. That there's, and even then there's a chance of the overnight reversal. So you have to be careful. So what you really want to see is a consistent, strong, unreversed move that lasts. Then you can start being confident, then start looking at the sectors, seeing where the move is coming from, what is it affecting the most. Obviously, if it's a dovish Fed, you're going to start seeing tech going up. If it's a bearish, it's a hawkish Fed, you might see energy go up, but other than that, you're going to see everything else going down. So be patient with it. You're going to get a move here, one way or the other. 500 is a pretty stubborn line in the sand on SPY. It's where we're at. It would take a fairly hawkish Fed for us to get a significant move breaking that 500, but this is where it would happen. And the market knows it, and that's why it's hanging right around that line. It's just prepping itself to break that major support level on any indication that we are having, potential for no rate cuts this year. The quantitative easing isn't not going to go as much as they thought. Might even be another rate hike on the table. Whatever it is, that could do it. So just keep your eyes and ears open. Wait and be patient. You will get your chance. Second mouse gets the cheese here.
Yep. And so above AVWABQ in the 50-day, you're a buyer. Below the 100-day moving average, you're a seller. If you are a buyer, you're looking at NIO for Harry's pick today. And you are looking at MMM for my bullish pick today. And you are on the bearish side, both retailers, which is interesting. I'm on the Target bandwagon. I like that short. And Harry likes BBY on the short side. That's all we got for you today. Trade well, be prudent, and I will see you Sunday. I'll do a video recording then.
Pete, always a pleasure.
Always a pleasure. Thanks so much, Harry. We'll talk soon.
Bye-bye, everyone.
All right. Bye now.